I'm going to bring up my next guest, who's largely bullish on the stock market all of last year. Joining me now, Kobeissi Letter editor-in-chief Adam Kobeissi. Adam, I miss you in studio, my man. Everyone's been saying, where's Adam? Where's Adam? I had to get you in, even though it was via satellite. Before we even get to the stock market, though, I want to ask you about bonds. Because I think at some point you were short TLT, and TLT is starting to take off here a little bit. Did you cover? What are you doing with bonds right now?
Yeah, so first, Charles, I'll be back in studio soon. I always love joining you in person, but thanks for having me today. I think on the bond side of things, it's been an interesting trade because the long end of the curve is finally starting to pull back. Yeah. The Fed controls the short end of the curve now that we're seeing the 10-year, 30-year start to come down. I think, we did cover that short. I don't necessarily think I'm chasing this rally in bonds here. I think going into next week's meeting, expectations are pretty dovish. We've been calling for a 25 basis point cut on the show for the last 2-3 months, 25 bips cut, that is. Markets are now seeing a rising chance of a 50 bips cut. I don't really think we see any 50 basis point cuts this year at all, primarily because the Fed's going to continue to hedge against the inflation side of things, even though the labor market portion of their dual mandate has clearly become the driving factor of monetary policy. But
I know you're a guy who respects momentum and trends, so you're just going to kind of stand back as far as the bond market's concerned?
Yeah, so I think, look, gold and bonds are now starting to move together, and both of which are in a strong uptrend. The reason that we've been skeptical of the bond rally was less because of the Fed, but more because of deficit spending and these relentless Treasury issuances that we're seeing on these 10-year note yield plus, which really kept yields high all year. And I don't think that factor is gone yet. Now, on the flip side, gold, which I know you always call me the youngest gold bull. Now we're at 3,600, 3,700. I think both gold and bonds could see some weakness just kind of after the Fed decision, just because of how much is priced into the market here. But ultimately, I've been saying gold to 4,000. I think we could see gold to 4,000 before the end of the year. Gold is crushing just about every asset class right now. And it's incredible to watch it happen.
Right, and you put out a chart also noting that even adjusted for inflation, it's at an all-time high. Again, we talk about momentum. There's clearly a tremendous amount of momentum there. Adam, I want to talk to you about something I find to be really, really kind of almost amazing in many ways. The universe is turned upside down, right? So the dumb money, right, retail investors, this is 2025. All they did was buy. They bought the dips. They bought. It was the smart money that was selling. All of a sudden, here we go. The retail is selling a little bit, and the so-called smart money folks are buying. And to even further the point, this morning we found out that the bearishness amongst retail almost back to 50%. What do you make of it that all of a sudden it's the Wall Street that's got to chase this rally, and it's the new smart money that's getting out, or at least being more cautious?
Yeah, well, it's incredible because if you look back, we've been tracking this flows data very, very closely, as you know. If you look back to May, April, even June, institutional investors were selling heavily into the strength. But now that this rally has become, now we're up over 30% since the April low in the S&P 500, one of the best recoveries in history. It's actually in line with 2008's recovery. Institutional capital has to chase this rally. Why do they have to chase the rally? Because they have to explain to investors why did they miss the rally in Q2, right? And I think that's, if anything, all this dry powder coming in is great. It's a great sign. I don't necessarily think we're anywhere near a market crash. And I want to emphasize the point that right now, if you look at the macroeconomy, we have rate cuts that are coming into what is probably the biggest technological revolution since the internet. And whether or not you think it's a bubble or not, it doesn't really matter, because right now I think we're going to continue to push higher with the capex that we're seeing. Hundreds of billions of dollars of capex coming from the Mag 7 per quarter at this point. Right. It's a great time to kind of keep riding the trend in the long term. I think over the near term, you're always going to see this volatility, a bumpy road ahead because of the uncertainty that we're facing. But I think a lot of the institutional capital now kind of chasing this rally, and retail actually saying, you know what, it's time to maybe cash in some of our gains. That's not a bad sign. And I think, looking forward, we don't really see any reason why both retail and institutional won't keep chasing this rally. I really do think it has room to run.
No, it really, it's to your point, right now the third best rebound in history, close to the second. And you've been bullish on the stock market. That's one thing that you've been very consistent about. I know you keep having to raise your target. I can't wait for you to tell me 7,000. Maybe the next time when I see you in studio. Adam, great work as usual. Thank you so much. Appreciate it.
Absolutely.
All right,
Thank
folks.
you, Charles.
See you soon.